Let's start with CPI because that was the big thing that happened at the start of the week, and uh, slightly higher, but shelter's really the main component that's keeping things up, like part of the core services there. And a thought that I was having, shelter is one of the most lagging components of CPI. So I'm wondering, is it possible that we're actually getting a slowdown behind the scenes, but it's not quite showing up in CPI, and we are actually starting to get that disinflationary effect? And if growth isn't really increasing, which lately over the last couple of weeks, actually, growth has been stalled, and then we also have this disinflation, is it possible that the market could get sidelined, or not sidelined, but market could kind of get blindsided by an actual disinflation that's happening behind the scenes?
Well, I think that, if you take shelter out of inflation, obviously you have a completely different number, and the underlying measurements of shelter outside of the official ones being used in core services differ across whoever you ask, right? Some people use the Zillow index, etc. I I think ultimately that disinflation hit some sort of headwind the last couple of months. I'm assuming it's somewhat tariff related, but at the same time, inflation is down inflation has fallen this year, right? In the last 6 months, inflation is down, right? In terms of disinflation is we're not in deflation, but disinflation has been working the last 6 months. And I'm not saying that disinflation is over, but I think that you've reached a point where, you have negative drags on the inflation number already, that being energy, foods, a small contributor, core goods, even smaller, right? So it's really core services. And you have this situation where, like, if commodities bounce, which they seem to be reversing upwards, right? We're back to almost 2023 highs on commodity baskets. If we can get up there, not necessarily breach above, but just get up here and stay here for some time, I think what ends up happening is you have some very interesting base effects coming into play in the next month or two that will keep the energy or slash commodity side of the inflation equation elevated, right? And I don't think it's necessarily saying that disinflation's over, but I think that our system has been picking up on some sort of somewhat of a material rise in inflation impulses. Again, that's just directional. It's not necessarily um, it's not necessarily a magnitude measurement. Meaning, just because our growth impulses are strong, our growth and inflation impulses are strengthening, it doesn't mean that, for example, inflation has to rip back up into the fours, fives, sixes, or stuff like that. I think that you have a period here where disinflation may have some trouble. And we're going to see later this month with the Fed, right? We're going to get the SCP later this month, and the last SCP happened before Liberation Day. So you can only imagine what the Fed is going to have to say on their inflation target revisions based on the tariff implementations that happened after the last SCP meeting.
Yeah. Yeah. This week we actually also got some progress with China. So we now have some tariffs in place with China, and there's still negotiations going on. So it's pretty good to see that there is traction on that, and I think the market's really liking that. There's a lot more certainty around the tariffs at the moment.
I think also at the end of the day, we have to understand here, and there's some sort of fiscal driver in inflation, right? It's very hard to quantify like what percentage of inflation. If it was very easy to quantify, it would be a public figure that anyone can reference, but it's very hard. How much the deficit is actually um, juicing the inflation numbers, right? If the it also matters your location in the economy. Are you outproducing or underproducing? Are you under an underproducing economy or an outproducing economy, right? So if you're over capacity or under capacity, and if you're over capacity and you have a deficit, well, then it's probably easier to bleed into inflation than if you're running under capacity or you're in a negative output gap economy where at that point inflation is just you're trying to stimulate yourself just into a baseline higher, right? So there's obviously so many dynamics here that play into the role of how inflation bleed or how the deficit bleeds into inflation at the end of the day. And I think that where we are right now, we're in a position where if the economy is running over above potential, it's probably safe to say that the deficit where it is today is going to act as some sort of support for inflation. So to sit here and say that inflation can fall, inflation is going to go sub 2%. It's possible, but you may have to have the Fed sit at 3.5 to 4 or whatnot for that to take place. Like if we look at the terminal rates at the Fed, and you really just look at these, you zoom out like from a bird's eye view, and we look at where we are right now. Terminal rates are actually quite high in compared to history. Like back in 2020, right before COVID, the terminal rate was forecasted to be at 1.3%. This was actually the same time where inflation on a year-over-year basis was around roughly the same level. So inflation was at the same level, but the terminal rate is something along the lines of 300 and roughly 300 basis points higher, right? Or 200 basis points higher, excuse me. We're 200 basis points higher on the terminal right now for the cycle lows, yet inflation is at the same level. And I think that the real understanding here is this difference, what's driving this gap is really just that fiscal stimulus that's being baked into the inflation numbers. So what I guess I would leave this off with is you could see inflation fall to 2%, maybe 1.5, disinflation continue, but it's going to be at the cost of a higher or a much more restrictive Fed.
Mm.
The Fed isn't going to be able to walk back policy and drop the rate to where they were in 21 or early 20 before COVID, just because inflation's at 2%. What I mean by that is,
Unless the fiscal spending also pulls back and we're still able to maintain that high growth.
yeah, but I don't see how we're going to cut the deficit significantly very quickly
Yeah.
here.
Yeah, we just saw the Doge cuts, one of the Doge cuts for like 9 billion get approved. So I know that doesn't make a dent, but I think that does add some confidence that they are trying to do something about the deficit.
I think it's a issue that I think has a solution, right? It's not a problem that's a runaway problem. You can fix this. It's just going to take some time. And I think that the reason I bring up the deficit and inflation is the Fed. So you want to hear my like back office theory or backhand theory here on the Fed?
Yeah, let's hear it.
I think that the Fed is basically at a position right now where over the last like a year and a half or so, the output gap accelerated and it's pulled back a bit, but it accelerated even more. And the Fed's in a position where they know that like if they cut rates here, they're basically going to send it to the bottom line. They're going to basically just juice inflation because the fiscal's running hot, right? Fiscal, 5, 6, 7%. You're well beyond the 3% guide deficit. You're in 6% plus, and I think that at this juncture where you are, the Fed cutting rates is only going to really just fall. Remember, they're not cutting rates to stimulate anything because the economy is already running over capacity. So what are they cutting for, right? And the quick answer would be, well, if the deficit were half of where it is right now, the output gap would probably be smaller as well, and the Fed could cut. And that's a possible situation, but it requires you bringing the deficit down. And the Fed can't come out, in my opinion, and based on what Powell is saying, he definitely doesn't want to sit on the stand and say, yeah, we're not going to cut rates until you cut the deficit, because that would be an implication that the Fed is trying to guide fiscal policy. And that's something that Powell wants to claim independence from. So I think that at the end of the day, if you were to sit in the closed room of the Federal Reserve when they have these meetings, it comes down to this. The Fed is almost cornered or pushed up against the wall based on fiscal to keep rates higher than they normally would. And in a simple definition, the way the Fed will represent this data is by claiming a higher higher neutral rate, a new high in the neutral rate, or a shift in the neutral rate higher, which makes sense. That's what happens when you have an overproducing economy with a high deficit. Your neutral rate's going to rise. And the Fed is just going to anchor on the fact that unemployment, like if we look at the unemployment rate, is, we're talking unchanged here, pretty much. Sam rule is nearly at 5% to trigger. So the Fed is going to say, okay, there's a lot of room here in unemployment that has to take place for us to like trigger some concerning momentum. Inflation they could just sit here and claim that inflation is not at target. And I think at some point, to my point, to what I was saying earlier, I don't think Powell thinks inflation is going to get to target quickly with the fiscal situation where it's at. So Powell can basically allude to the fact that they're not cutting for above target inflation and tight labor. But what he's really saying is he can't cut because of fiscal. But he's not going to say that just that outright. And I think that's where the Fed is right now.
Yeah. Yeah, like if they say that, it's just going to piss Trump off.
Not even that. I just think that they do not want any political they don't want any crosshairs on them politically more than they have already. And becoming a political organization to the fact where they are not so much independent, they take away from their independence and they start taking shots at whatever party is, it's going to be seen as a Republican Party shot because the Republicans are in party, right? Or in power, the Republican Party's in power. I think Powell doesn't want to do that. He doesn't want to put the Fed in a position where they become, they pick up these crosshairs for anything that's politically motivated. The last thing the Fed wants to be known for is not cutting rates due to political motivations. Powell has fought this tooth and nail the last 6 months based on the summer rate cuts we saw last year into December, right? Powell has fought those cuts on the fact that it wasn't to help Biden or help the Democrats win. He was saying that the Fed was just a little too tight and they rebalanced. It was those were called rebalancing rate cuts or recalibrating rate cuts. And I think that right there, Powell basically saying like we've kind of reached the end of our road for cuts, for material cuts at least. Like we are seeing that the Fed can cut some. We're at we're sitting here at 4.3%. The cycle low is at over the next 2 years is at 3.3. So there's about 100 basis points of cuts baked into the market already, baked into the curve. And I think going beyond that is going to require either a breakup in unemployment or a real breakdown in inflation. But again, remember, disinflation has been slowing quite a bit as we fall towards that 2% target, which gives me the feeling that there's a buffer in here. Again, can't compute it, but I'd say, just give 1.5, 2%, et cetera. Say that much is being fiscally driven into the inflation numbers, right? Therefore, it's unlikely that inflation just nosedives towards zero. Therefore,
Yeah.
the Fed is not going to have that inflation driver to say, oh, no, we have to cut rates, right? They can that's why Powell's been saying, oh, the risks are balanced. The risks are the risks of labor are becoming more balanced. It was inflation for all this time, but inflation is not really a concern. It's really labor right now. Powell's not telling you that inflation going too low is going to scare you, even though it would if it did happen, but it's not on the Fed's mind because it's just it's very unlikely given the path of fiscal and where we are right now.
Yeah. Let's talk about the US dollar. What are your thoughts on what's happening with the US dollar right now and how it's going to affect stocks and bonds going forward?
Well, I think a weaker dollar, it depends on, it really depends on why the dollar is weakening. And it seems to be that, the first wave of dollar weakness that we saw from February to April was really like viability based. Like people were really giving up on America. Now you're just starting to see like other currencies continue to strengthen as, people reshore money for markets at home, and tariffs become a global issue where countries are trying to figure out how to basically play a capital game with America. And I think that, given the dollar is where it is, I'm not saying that, it's not down. It's definitely been falling quite a bit, but it's hard for me to be upset or scared about the dollar when like we were so much lower so long ago. Like not so long ago. I'm sorry. We were at 85, or let me pull up DXY, which is a little bit better representation. We were at 90 points on DXY in 2021. People were like, "Oh my God, 2-year low in the dollar," but it's like, okay, like it's not even like this is not even the worst the dollar's been in the last like 5 years,
Yeah. Well, it seems
five to
like
ten
that
years.
correlation that people always talk about of dollar down is bullish for Bitcoin, that doesn't seem to be really a thing anymore.
Yeah, well, Bitcoin kind of has taken this role that again, Bitcoin's not priced in US dollars. Like I think that's a big thing that everyone has to realize. Like maybe it was more dollar dominant, um, or dollar denominated earlier on in its life cycle, but Bitcoin's priced to whoever's looking at it. That's how it works. You know, kind of like gold in a way. Gold's priced to the viewer, not to some are like yeah, people like to quote gold in US dollars, yes, but it's not like Apple stock. You don't need US dollars to buy gold. You need US dollars to buy Apple. So same thing with Bitcoin. You don't need US dollars to buy Bitcoin. So I think that's probably one of the factors there that takes the dollar aura out of Bitcoin
Yeah.
long term. Yeah.
Yeah, that's a good point.
Um, bonds though. Let's talk about bonds because what a move today, man. What a move just overall this last week. Got up above mid vamp on Tuesday, and we've been just pumping on bonds. It's very interesting.
Yeah, I think it was a very slowdown esque type of week. So even like defensives did pretty good this week, and now we're seeing bonds as well.
Do you think that this is the start of a new bond rally, or do you think that we're just going to see this kind of like flutter out and just fade back down at a low?
Well, we're still in a slowdown, so I'm anticipating chop unless
Yeah,
this slowdown
I could see that too.
accelerates. Because right now, like growth is just pinned between slowdown and risk on. Like it's very close. So if slowdown pulls back a little bit and we're actually more closer to risk off, then I can see bonds having some legs here. But where we are right now, where we're just on the verge of flipping to risk on, I think we're just gonna get chop.
I kind of have to agree with that. I mean, bonds, just let's look at the 10-year, right? I know for simple sakes here, 4.5 has been a key area the last couple of months in the 10-year, and we just can't hold above it. And we're now at the point where I think that if we can't really get above it, bonds are going to try some sort of rotation, or rates are going to try some sort of rotation where they fall a bit. I'm not saying, we have to go down to 3.8, but maybe 4.25, 4.2. Just obviously Momo's got to be we got to clear Momo here, and we could go down a bit, just test out the waters after failing like 1, 2, 3, 4 times to break above 4.5. And maybe there's some catalyst later on that sends rates higher again. I guess the point here is that we're still in this tight range on rates. The market is holding steady here because again, it's not sniffing out a recession. This is what happens when the market starts sniffing out a recession. And I mean, this blow up here was really this was like a liquidity cascade issue in the bond market. I wouldn't take this move up as seriously. I mean, we came from 4.8, we pierced through 4. We came off of 4.8 when the market started sniffing a slowdown, and we haven't made new highs since January. And when did we pivot into slowdown? I think it
On
was like December.
May, or no, not May 5th. That's when we entered our position. But yeah, it's been a while since we've been in slowdown.
What happened was we've closed up last year in slowdown. Risk off came somewhere around here, and then we were back into slowdown like May 5th. And
Yeah.
all in all, like rates are pretty much unchanged in this version of the slowdown. Risk off, we had that whole liquidity cascade issue, but overall, from the original slowdown call, rates are down. So I think that makes sense. But we're not sniffing. This was what the market was doing when it was sniffing out a recession last summer. With
Yeah.
labor really like that was when the labor market that's why the SAM rule is so important because even though even though the bond market is somewhat steady right now. The unemployment market, excuse me, even though the unemployment market is steady right now, last summer we started seeing this rapid acceleration into the summer, and that's where everyone started getting scared. The market, the Fed, everyone's like, "Oh, great! Like this is about to snap and break up higher and run." You know that typical unemployment situation where the SAM rolls above zero point 0.5. But what happened was we were just coming from such a historically tight place that we kind of it kind of broke the SAM roll there. I think we're getting to a point now where we're stabilizing at a higher, more normal rate, right? We spent a lot of time near record lows. Now we're up a little bit better. We're up a little bit more, becoming a little bit more dynamic, a little better. I think that we need to see the SAM roll trigger again for a recession.
Yeah,
So
like
as
this time, if it were to happen again, it's not going to be because employment is too tight and it's just catching up and going to a more normal level. That's what the last SAM rule trigger was for. Uh, but yeah, from now that we're at 4.2, that's much more of a normal level. So I think if we trigger it from there, that's pretty dead set that we're going to get a recession if that happens.
Yeah, I'm pretty sure the trigger point's got to be like 4.8 to 4 to 5 at this point. So basically, what I'm saying is, for us to get a recession, unemployment's got to move to 5 pretty quickly. And without that happening, and that the bond market's telling you that at the moment, that's just not that's just not what the bond market's thinking. Like when the bond market was sniffing out like that unemployment weakness, it started breaking down in early June. Could we be seeing the start of that now with the 10-year starting to break down? Yeah, but it's not we're not there yet. It's still very early. Like if we were if bonds, like you said earlier, like bonds shopping around slow down, right? Like there's not a lot of momentum here. If bonds were at Momo breaking up and starting to look like they were going to go bullish trend, my take would be different. I'd say, okay, listen, like maybe the market's starting to think that there might be an issue, but bonds down here, nah, it's hard to claim that the market's sniffing out anything with TLT at 87.
Yeah, and with growth pinned
Yeah.
at the edge of slowdown, about to go risk on, that's yeah. Like if we see TLT at Momo and growth is about to fall out of slowdown and into a full on risk off territory, 100%. Yeah, I think bonds are sniffing out a recession at that point, and our system would be aligned up with that.
Yeah, right here it's just more of a random walk price action chop. That's what I'm seeing in bonds for
Yeah,
right
like
now. And
if
I
if
I think
if TLT goes to Momo and growth is still almost in risk on at the edge of slowdown, I that would be a short in my books. Short at Momo.
yeah, I think that's a not a bad take. And I think we'll wrap it up on Bitcoin. Where do you think Bitcoin's going to go from here, up or down?
I mean, Bitcoin from as of late, as of the last few months, Bitcoin seems to be front running our system a little bit, front running risk dynamics. So it really depends. I don't know. I think we're going
Okay.
into
Okay.
risk on, so I think Bitcoin's going to move higher. That's where I think inevitably in the next month or so we're probably going to end up.
In
But
risk on, you're
yeah,
saying,
in
okay.
risk on. I think we're probably going to end up in an expansion regime that kind of expansion or inflation, one of the two. Inflation actually looks more likely now with the recent inflation price action. So yeah, in that case,
Okay.
I'm bullish Bitcoin. I think it's also sniffing out a slowdown at the moment, just like bonds are, and potentially trying to front run it.
I mean, yeah. So disclosure, we've been long Bitcoin for a while now, so we're up in our Bitcoin position. So for us, it's like we're just riding the trend at this point. Um, but for what you were saying already, absolutely. I think that, look, slowdown or risk on, Bitcoin can do well, right? That's the whole key here. That's why we bought Bitcoin through slowdown, because it can do well in a slowdown. It tends to do really, really well in risk on. And I think that if you're long Bitcoin, the simple solution, or the simple gauge of short-term momentum right now, is going to be mid-vamp. As long as we're having some trouble today, actually, as of recording this, but earlier we did bounce off of it. I think it was, what when was that? This afternoon? It was like right around here, from early morning to the afternoon. We bounced off of mid vamp, which was we came down to 1066, and we bounced back up to like 108. We're now down to 106.1, but ultimately, if we could defend this mid vamp zone, you kind of set yourself up for um like a false breakdown, breakup, and possible breakout to new all-time highs. And I think that that's a likely situation as long as we're not in risk off and the trend's bullish,
Yeah,
right?
pretty much. But Bitcoin does like to front run risk. That's my worry is it sniffs out risk off before we can sniff it out or before our system can sniff it out. But I think odds are we go to risk on. That really seems like what's slowly building up to. And that's what
Oh,
the stock market's been alluding to as well.
yeah. I think that's true. And like I think we also have to touch on the fact here with Bitcoin. Look, if you lose mid vamp and you can't hold this 106.6 level, you can just do like bullish trend chop rotation all the way down to 100, and it still wouldn't be bad. Like you can just do this range consolidation before breaking up. It's possible. It's not what we want to see, obviously, but just understand that's why it's very important you control your leverage with Bitcoin, and preferably minimal to no leverage at all. Because what ends up happening is you can have you could have a 6% range here very easily, to lower vamp 6% range, still be within well deep in the bullish trend, holding it, regime's just chugging along, and then out of nowhere you get some rapid price move up like this where you just rip, and that's Bitcoin. So you can't be extremely tactical with it. You kind of have to let Bitcoin do its thing, which is why our model is designed to be as low touch as possible with Bitcoin to try and capture as much upside as possible. And our key here is if we can hold 106, I think the odds of us hitting all-time highs is a lot higher for a shorter time frame than it is if we hold and start rotating down, because then like the time will probably have to extend as we consolidate, rise, break back up, and then finally go for the new highs.
Yeah. And I think depending how long we're in this slowdown for, and if we kind of start going into a deeper slowdown, that's definitely where we would see some more chop in Bitcoin. But I think
Yeah,
being close to risk on, but still in a slowdown, that's pretty bullish for Bitcoin still. And if we flip onto risk on, it's game over. That thing's going. That thing's going. Like especially if we're in an inflation regime, positive growth, positive inflation, Bitcoin runs hard during that regime. So I'm crossing my fingers
I
for that one.
I know we don't do price targets, but in a risk on regime, where are you guessing Bitcoin goes to? Just guess. You don't even have to look at the chart. Just guess.
160.
160?
That's just a
Okay.
wild guess. Obviously depends how
Random.
long the risk on regime lasts.
Okay.
If
Okay.
it's like a solid like 6 month risk on regime, I could see 160.
That would be a fun ride now, wouldn't it?
Yeah, that'd be pretty sweet.
All right, but I think we'll wrap it up there. Thanks guys for listening. If you have any questions, feel free to reach out to us on our website at market-radar.com, or go to our X account at the Market Radar. You can get all of our models and access to our data right now. Thank you.